Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade, and here's what you need to know. US and European futures stabilise after recession fears see the Nasdaq tumble to the worst day since 2022. President Trump is set to meet business leaders later today, but he has angry rhetoric for Canada on tariffs. Plus, Germany's Greens demand tougher rules before they can support defence spending. But the euro rises as the party's co-leader tells Bloomberg TV she hopes for a deal this week.
In the meantime, a quick check on these markets here. Green on the screen when you look at the futures picture on both sides of the Atlantic. Kind of expected given the market sell-off that we saw yesterday. Euro Stoxx 50 futures outperforming this morning higher by 0.4%. But even the FTSE and the S&P right on its heels to the tune about 0.2%. I've got one eye on euro dollar, though, as we kind of watch what's going on in Germany, as Anna mentioned, 108 on that currency pair. The countdown to the opening trade starts right now.
Tuesday the 11th, good morning, folks. It wasn't exactly a Black Monday, but it was pretty ugly out there yesterday, wasn't it? The real question now is, where do we go from here? Is there enough to stabilise the situation? We're down circa 10% on the S&P. The Nasdaq, as Anna said, had a pretty ugly day yesterday. What next is the real question, and do we know, given what Trump is doing right now?
Right, absolutely. So much uncertainty, so much volatility. Morgan Stanley talking yesterday about the amount of volatility they expect in the first half of this year, certainly, as the policy is disclosed gradually. In terms of where we go in the very short term, yes, futures look a little more stable, up 0.4% on Euro Stoxx 50. But the broader story is around the Trump bump giving away to a Trump slump, and that seems to be where markets have got themselves caught. So the Mag 7 now down since the election, so we've erased gains on the S&P. We've erased gains on the Mag 7. Citigroup now downgrading US stocks to neutral and saying that US exceptionalism is certainly on pause. And we now have a 50% chance of a rate cut in the month of May. Such is the pace of the markets rethinking about the weaknesses and the vulnerabilities of the US economy.
You mentioned Citigroup, HSBC doing the same. So you're starting to see Wall Street kind of catch up to this narrative that it's not the uncertainty people are reacting to anymore. To your point, it's the economic resilience that's completely dissipated, stimulus savings that are no longer saving the American public from reciprocal tariffs.
We are looking at retail buyers getting caught out. That's an interesting angle on this as well. It's been really difficult not to have bought the dip in prior occasions like this, but those guys are getting burnt now. I think that's a significant tell on where we are with this market and the pace of it. I also think the corporate news is fascinating, Kriti, and what we're seeing. So I'm going to talk about Delta. You're probably going to talk about Oracle and what we saw overnight. Ed Bastian out cutting guidance. He says he thinks actually the slump we're seeing in consumer expectations around travel plans is probably transitory. That's a dangerous word to use, isn't it? But he is talking about that. Are we already seeing a hit to consumer confidence showing up in airline ticket sales? And if we are, is that just a precursor to a broader kind of consumer slowdown?
Yeah, it's a really interesting story. You do wonder how much translates to Europe, as some of it seems to be connected with some of the safety issues that US aviation has had of late, and maybe the European consumer not quite watching those quite so much.
I will kind of add into that what Air France said last week.
Yes.
Like, we talked to Ben Smith. He talked about the extraordinary spending of US travellers in their ability to want to come across the Atlantic and the money they're prepared to pay for it.
And talking of spending, are we still seeing tech companies spend on AI and CapEx and all of that story intact?
So this is the tale of two corporates, right? You are starting to see the consumer sentiment perhaps reflect in the likes of Delta, but then you're looking at business investment not really touched by perhaps some of the jitters you're seeing on Wall Street and those recession fears. Oracle did miss their earnings, so you may see actually a reaction in the pre-market. I believe that's starting in less than an hour or so over in the States. But they're still going very hard and aggressive when it comes to the AI spend. And I think that speaks to this idea that ultimately, if we're looking for companies that have liquidity and that haven feeling, maybe tech may be back in vogue. If there's a reason to buy, that may be one.
Does the consumer react first and then corporate second? Is the consumer slower to... Is the corporate story slower to react, maybe? I don't know. Maybe that's one way of looking at that.
Absolutely. Well, let's go back to maybe what's coming out of Washington, what's emanating out of Washington, because in addition to Oracle, in addition to Delta, we've got plenty of Tesla news as well, plenty of commentary coming coming out of Canada when it comes to Donald Trump. And we know that the kind of tension is really intensifying, of course, with Donald Trump and China, with Mexico, arguably the EU, but definitely with Canada. This is the closest neighbor, the closest ally to the United States. And already, Mark Carney coming out with some fighting words yesterday. It looks like that narrative continues today.
Yeah, the war of words with Canada, really intense, isn't it? Really quite incredible language being used there. Interesting to see Tesla was down 15% yesterday in hours. President Trump, one of his priorities seems to be to come to the aid of Elon Musk, saying he's going to go out and buy a Tesla today. That's one of the things he's going to be busy with today. But he's also going to be meeting with business leaders. And you wonder what the tone of that conversation is going to be, because to this point, he's been quite open, saying, look, this is about a transition. This is a transition period. How is that going to go down in front of those business leaders? You really want to get some clarity.
Is he going to tolerate a recession? Is he going to tolerate a recession early on in his presidency? Does he almost want a recession early on in his presidency? A reset? That certainly is what Scott Bessent is talking about. That seems to be the narrative. Basically, Bessent wants to wean this economy off government spending. Is he going to make that message clear to these business leaders? And people like Jamie Dimon and Jane Fraser are going to be there today. This is Wall Street front and centre, getting the message. And you wonder what their takeaway from this is going to be, if that is where Trump is directing them.
The timing is everything here, because it's a crucial point that if you have a recession early on in the presidency, you can control the narrative going into the end of the presidency. But also, you have to time this perfect, because there's still midterm elections coming in less than 2 years, really. And you have to look at not only the recession fallout, but then the kind of recovery fallout as well for the Republicans to hold that majority in Congress. And that's really something that Donald Trump hasn't used yet, but may need in the future.
Yeah, I mean, and if you want to do drastic things to the economy, if you structurally want to drastically change the economy, to your point, Guy, what is the downside that you are prepared to tolerate to instill that? And if we're going to get an open conversation about that, that will be fascinating. We'll see what comes out of that dialogue with business.
Is he going to talk about tax cuts? Are we going to talk about that kind of early sort of expectation that we would get tax cuts, that we would get this deregulation, because that seems to have faded into the background? Is that going to be reinforced again today? That is coming. There's good news. There's further good news to come. We've just got to get through this period of pain.
Meanwhile, here in Europe, we're all focused on whether the defence spending in Germany is going to get the necessary support it needs in this old parliament to get it through. It's
amazing, the German politics and the wrangles that we are seeing there. So Tom Mackenzie speaking with the co-leader of the German Greens in the last hour of the prospects for a deal with Friedrich Merz.
We have been ready to negotiate since the night of the elections. We have been surprised that there has been nobody really engaging with us seriously.
Do you think it's likely that we could get a deal by the end of this week?
No, I really hope so. I'm like, the situation is dire in Ukraine. We really need Europe to speed up its own defense.
So the co-leader of the Greens there, speaking to Tom a few minutes ago, talking about the fact that a deal is possible. So the German papers this morning are asking the question, what is it the Greens want? And I think the answer is, clearly, judging by the conversation that we've just heard, more specificity.
Yeah.
More clearly defined spending plans. Where are you going to spend the money on defence? Are we going to actually see a bigger, broader definition of what defence includes? The Greens in Germany are hawks. They want to see defence spending. They actually probably want to see more defence spending. They probably also want more specificity when it comes to the infrastructure story, making sure that that money is spent on infrastructure, potentially on green infrastructure going forward. So that's what they're looking for. Tom's conversation, look at that. That was the impact that it had on the euro. We've just had it up for you. There was a positive reaction in the euro because this story yesterday sent shockwaves around Europe. Is Germany going to deliver? And I think the message this morning from the Greens is yes, but we just want a tighter deal. We want to understand exactly where this money is going to be going.
This does sound like, listening to what she was saying there, it does sound like a party that wants to find common cause when it comes to defence, and there is then expectation that a deal could be done, but it's also a party that's having a moment in the spotlight and a little bit of power, and therefore could take this to the brink. And there's a really interesting one. I was reading some research by Deutsche Bank yesterday that talked about how the Constitutional Court, if they don't think that there is the necessary amount of time to fully debate this in the current parliamentary session before the new parliament sits, then they could say that this vote is not able to take place. And so that would add extra, so it adds some extra drama as we get up to these deadlines later on in March.
March 25th, 14 days, and already the market pricing in as if it is a done deal. Is that a dislocation we have to revisit in a couple of weeks?
But the fact that the market is putting it through as a done deal, the fact that Europe has reacted, the fact that von der Leyen has reacted in Brussels makes it harder for Germany, harder for Germany's parties to go back on this. The implications of going back on it are so much greater now. that it would make Germany look ridiculous. Potentially, the kind of the electoral effect of this could be quite bad on a party that has potentially made it not happen. The Constitution, of course, is a slightly different matter. Let's talk about what's coming up on the show. We need to get back to the markets clearly. Willem Sells, HSBC, Private Banking, Wealth Management, Global CIO, joining us in a few minutes' time. Olga Onuk, University of Manchester professor and author of The Zelensky Effect, is going to be talking to us about these talks that are taking place in Saudi today. We will see what comes out of them a little bit later on. We'll set you up for that. Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist. Couldn't ask for a better person to talk to on a day like today. And we are going to be speaking to Andrea Casalucci, Pirelli's CEO, a little bit later. We've got a Volkswagen interview coming up as well. We've got a big cars section of the programme a little bit later. Looking forward to that. Absolutely. In addition to kind of the markets and the earnings conversations that we're going to have, we are going to see plenty of geopolitics and some crucial meetings take place today as well. High-ranking Ukrainian diplomatic and military officials are going to be meeting with their U.S. counterparts in Saudi Arabia. We're going to see what that kind of deal actually looks like, if some of the ground can be recovered when it comes to that fallout between Zelensky and Trump in the Oval Office, I believe, last week. At the same time, speaking of the Trump effect, Greenland heading to the polls. We'll see what kind of rhetoric comes out of there, especially when it comes to the approach towards the United States. And then, again, the focus on D.C. when it comes to that data. You mentioned this yesterday, actually, the 10 a.m. UK time. We get that 10 a.m. U.S. time. We get the NFIB Small Business Optimism Survey. So if we start to see them feeling a little bit of the Trump pinch, and 2 p.m. U.S. JOLTS data as well, UK time on that. Yeah, both really interesting. NFIB, how is it reacting to what we've seen lately? How are businesses, small businesses, reacting to this? They are keenly attuned to what happens on inflation. They're keenly attuned to what happens on the unemployment story. Really good reflection of what is happening there. And the JOLTS story, of course, an interesting indicator into the labour market. The labour market, judging by the data we saw last week, reasonably stable. But are we starting to see maybe some of the survey data highlighting some cracks coming through? And, of course, we have plenty of analysis of the Ukraine story. As you mentioned, Guy, in just 20 minutes or so, we'll be having a conversation about that. We're waiting for the results of what comes out of those meetings in Saudi Arabia. Marco Rubio, kind of playing down expectations that we get any quick resolution here, because there are a lot of people thinking, how quickly can any kind of deal get done? But he's saying, he's sort of playing down that they're going to make a deal very quickly. And interesting to note that Trump's Middle East envoy seems to be expanding his remit. This is Steve Witkoff, of course. He's off to meet Vladimir Putin today. So there will be direct contribution, it seems, into the thinking of the United States coming through from Moscow. Does Ukraine need to show willing when it comes to a peace deal in order to restart weapons shipments? I think is the kind of the immediate, more near-term story around all of this, because that's having an impact already. There's been some suggestion that they're gradually lifting the restrictions on intelligence sharing now that Ukraine is getting around the table. Let's talk about what else we need to know this Tuesday morning. The Philippines says that former President Rodrigo Duterte is now in police custody after the International Criminal Court issued an arrest warrant following an investigation into his deadly drug war. Duterte was arrested by police at Manila Airport shortly after arriving from Hong Kong. Duterte is currently running in a mayoral race, seeking to reclaim a post that gave him national prominence for endorsing a shoot-to-kill style crackdown on crime. An oil tanker is still on fire in the North Sea off the UK coast after a collision yesterday morning. The search for a missing crew member from the other vessel has now been called off. The American-flagged tanker, which was anchored, was carrying jet fuel for the US Armed Forces. A pollution assessment is underway after the fuel spilled into the water. And Portugal could be heading for a snap election, with the country's minority government facing a no-confidence vote later today. Prime Minister Luis Montenegro's AD coalition appears to lack the support needed to win. An election could be held as early as May the 11th. This according to the country's president. It would be Portugal's third snap election in less than 4 years. Coming up on the programme, we will hear from VW's CFO after the German car maker says it expects profitability to remain roughly flat this year as it contends with muted demand. So much to talk about when it comes to tariffs and global trade. Plus, we will check on Oracle and Delta. Both of those stocks could be in focus. We'll get pre-market trading, of course, coming an hour early if you're here in Europe because of a reduced time difference between Europe and the United States this week, next week and the following week. Up next, European futures stabilise, but we'll dig deeper into the market story, of course, for you. If you want to get involved in any of these conversations, please do get in touch with us. You can use IB plus BBTV Go on your Bloomberg terminal to do just that. This is Bloomberg.
think it's going to be panic at the disco. We haven't gotten there yet. But, as these levels climb, there will be unwinds and more uncertainty that triggers even more.
It looks like those conditions are not going to change and the volatility is going to persist as long as we have uncertainty around tariffs and economic policy. But I do believe that longer-term investors can start looking at these levels, start putting their shopping lists together, and start looking at quality names that have been beaten up over the last couple of weeks.
It's the whipsaw that's going on that's driving the markets crazy.
I think that tariffs will be an issue. They have been marked as a major issue, and I know that the Chinese government for certain has it on its radar as part of its policies that it's addressing. What comes out of it is anybody's guess.
So our guest talking about the US market sell-off that we saw yesterday, Amy Silverman talking about panic at the disco. Has the music stopped? That's the question that I think a lot of people are asking themselves as they rush for cover. Obviously, we saw significant anxiety in the market yesterday. Where do we go from here? Valerie's here to talk about what we saw yesterday in the session and what it tells us about where we go next.
Guy, I, for one, was very shocked to see that now the drawdown in the S&P 500 is even worse than what we saw last August when that global market mayhem, when the Bank of Japan hiked rates. We're now 8.6% down in the S&P 500, nearing correction territory as we've seen the Mag 7 now wipe out its entire post-election gains. A lot of that driven by what happened in Tesla shares yesterday, down some 15% during the session. Its worst session in over 5 years for these Tesla shares. Now that's wiped out that Mag 7 gain post-election. Just when will this prompt any change of language from the Trump administration? Are they yet concerned about this equity market slide? It doesn't seem like just yet. Trump out a few hours ago, again threatening these tariffs, especially when it comes to Canada, calling Canada a tariff abuser. The risk for the markets here is, Guy, if we don't see a softening of language from the Trump administration, we might just see a change of language when it comes to the Federal Reserve. And on that, guys, we've seen a Treasury rally extend in Asia session. Those two-year yields hitting a fresh year-to-date low for 2025 as the market now prices in a 50% chance of a May Fed rate cut.
Things are changing pretty fast. Is the disco over? Is it time to head for the door and head home? Let's try and answer that question. Valerie, thank you very much indeed. Willem Sells, Global CIO at HSBC Private Banking and Wealth, joining us around the table. Time to go home? Is the music over? Is the disco done?
Well, I think the first leg of the sell-off in the US was related to other opportunities in the rest of the world. China first, Europe, and so on. Now it is it's actually worse than what we were talking about in terms of how the market has sold off. It has also corrected the run-up to the election from September. I think what the market is telling you is that there is going to be a big impact of all of this uncertainty on the economy. We are not yet seeing that obviously in the data. We will need to continue to see that, but even in the business confidence elements. So NFIB will be extremely important. PMIs, those kinds of things, as to whether this is really feeding through into a real downturn into economic data.
So too early to buy?
I think probably you're going to continue to have volatility around this because of this uncertainty. A lot of our clients are pointing to this Atlanta GDP now, which is obviously a very negative sort of indicator.
It's affected by front-running of tariffs, basically.
Exactly. It is the import component, which is worth about 3.8% apparently in the number. So if people are worried because of that indicator, I think that is misrepresenting actually underlying demand. The underlying demand is still stronger than that.
So the underlying demand is still there. Good morning to you, Willem. Where does that leave the Fed then? There's so much uncertainty in the first half of this year in particular, or maybe just for the next 4 years, I'm not sure. But certainly Morgan Stanley talking about the first half of this year. A 50% chance now of a rate cut in May. How do we approach our expectations around the Fed, given that they are watching to see what the Trump administration does, just like everybody else? Yeah, well, they need to look at the inflation, the growth, and then the deficits, obviously, as well, and see whether how they compensate for that. We have 3 rate cuts from June, September, December. We're happy that the markets came into our direction, but it shouldn't go much further than this, because you have the reason why we see those cuts is obviously on the inflation
inflation side, that you do see an easing of some of those pressures. And hopefully we will see that this month as well, where we do think that the CPI year over year and month over month is going to fall. But clearly there is an element of uncertainty around that because of the tariffs and then because of the fiscal spending that ultimately we may get as well.
Yes. And so how do you then compare what's going on in the United States with what happens in Europe? Because the fiscal spending is leading the conversation in a different direction here in Europe, and people asking whether, just how much is this going to boost the European economy? What will the multiplier be from defence and infrastructure? So what kind of positive expectation do you have for Europe at this point?
Yeah, so first, again, the first bit was that short covering that people had, and sort of, people being surprised by the conviction of the European, the European reaction, where you always need a good crisis for Europe to be shaken up and do something. Obviously, the question is how quickly this will lead into real economic activity. Let's also highlight that some of the defense spending, quite often, a lot of the defense spending is feeding through into American purchases. But ultimately, it should help with, stabilizing some of the sentiment, offsetting the tariffs, and so on. So I do think that we'll see a small pickup from that. Our clients are also obviously hoping for, a solution in Ukraine, which will, in our view, lead to a small uptick in activity. Obviously not a reversal of what we said, of what we saw, a number of years ago. But all of that basically leads us to a more neutral stance. We were still underweight France, which has lagged a little bit, that we've covered this week. So we have a neutral in Europe.
Guy likes to ask this question a lot about whether, if the United States moves 5%, does Europe then move 10, a.k.a. the multiplier, the beta effect, is it larger in Europe? But, Willem, is it fair to say that year to date it's been the opposite, that the U.S. has moved by a bigger margin than Europe has?
On the equity side, it's gone in the opposite direction, obviously. But I do think that because of that positioning adjustment, indeed, you have had a big move in Europe, a smaller market, where people needed to adjust that positioning. I think you shouldn't get our neutral view on Europe is because obviously, number one, you've had a run up. Number two, also because you still need that implementation. We still have structural weaknesses in Europe. Yeah. We're mainly talking about defense. We're talking a little bit about everything that Mario Draghi has said in his report, but we're not going to do all of that. So there are still structural obstacles. What our clients are trying to do in this uncertainty is, number one, get closer to benchmark because it's more difficult to take a view. Number two, diversify, and you have now the bond equity correlation that is negative, so that helps. Yeah. Tail risk hedges, but then also remain exposed to some of the things that they know is still going to continue. So those are thematic things, like the AI trade, the infrastructure trade, those kinds of things.
Well, I'm going to put you on the spot, 30 seconds. What happens if we don't see the Germans come to a deal that the market is already pricing in?
I think people understand that Europe takes some time. So I do think that they will then bet on European measures, rather than German measures. But obviously, you get a short-term volatility.
Succinct. A little bit of optimism. Willem Sells there, Global CIO over at HSBC Private Banking and Wealth, telling us there might just be a backup plan baked into these markets if we don't get that German deal come through. Coming up on the program, we're talking about one of the other things Willem mentioned, and that is Ukraine launching a record wave of drone attacks on Moscow as officials from Kyiv and Washington meet in Saudi Arabia to discuss a possible resolution to the Russian invasion. Is this something that the markets react to perhaps more than what's going on in the United States, at least in the short term? That's what we're going to discuss the details of next. This is Bloomberg.
Welcome back. This is the opening trade. This is the futures picture for Europe then for this Tuesday. And it looks very different to Monday, and that's good news if you're long of these markets. So European futures suggesting we will bounce a little bit, not making up for all the losses of yesterday, it would seem, by any stretch. And certainly US futures not pointing to any makeup of the losses of yesterday. E-minis are up 0.1%. NASDAQ futures are entirely flat. So we're really just flat on US futures. In terms of the bond market picture then, we saw a lot of people coming out of stocks yesterday and going into bonds. This is the picture. We're fairly flat on bond markets in Europe and after that incredible volatility of yesterday.
I'm curious to see what happens next when it comes to where the next leg of growth is. We've seen so much in Europe come off of course, the defense spending and these infrastructure promises from Germany, perhaps a little bit of stability, if I can say that, in France as well. So we kind of eliminate that risk as well. The tariff story in Europe is perhaps focused a little bit elsewhere. So a little bit same. Is the peace dividend in Ukraine perhaps where that next leg of growth actually comes from?
Yeah, I thought it was really interesting, your question to Willem Sells earlier, saying, what happens if we get trouble in Germany, trouble getting through this legislation? And he was saying, well, if that is the case, then we'll probably end up in a situation where the market thinks, well, Europe will come to the rescue. There'll be a European solution. But perhaps that's not where we are right now. Let's talk about what's coming up in Ukraine.
Absolutely. Let's go there. U.S. Secretary of State Marco Rubio has downplayed the possibility of a breakthrough in today's meeting in Saudi Arabia between U.S. and Ukrainian officials, saying that talks will focus on potential concessions. Now, this comes after Ukraine launched one of its biggest drone attacks at Moscow since the war began. For more, let's bring in Greg Sullivan, Bloomberg's Russia economy and government editor. Greg, walk us through this meeting. What can we actually expect to get out of it?
Well, a few things. As you mentioned, Secretary of State Marco Rubio was downplaying expectations for a major breakthrough. He was really emphasizing that the U.S. was in the position of listening and trying to feel out what sort of concessions were possible. He did mention that concessions were expected from both sides, including Ukraine, potentially on territory, which would be a hard pill for Ukraine to swallow. Now, these talks are going to be very tough for Ukraine. They are high stakes. There's no question about that. We saw last week the disastrous White House meeting with Zelensky and Trump. The Ukrainian side is really seeking to tamp down tension and maintain their seat at the negotiating table, continued engagement with the U.S. as these negotiations progress. Anything concrete seems somewhat unlikely, given that both sides attacked each other with drones overnight, including Ukraine attacking Russia with a record-sized drone attack, including many against the capital, Moscow. So that doesn't underscore that the two sides are necessarily getting very close. But as you said, U.S. envoy Steve Witkoff is planning to go to Moscow, so some signs on that front as well.
Greg, thank you very much. Greg Sullivan, Bloomberg's Russia economy and government editor. Joining us now is Olga Onuk, who is a professor of comparative and Ukrainian politics at the University of Manchester and the author of The Zelensky Effect. Professor, thank you so much for joining us. Good to have you on the programme. So as we were just hearing there, Marco Rubio, the US Secretary of State, has been somewhat downplaying expectations that we'll quickly make progress in these talks between Ukraine and the United States that are taking place this week. What is your expectation? What progress are you expecting to see?
Well, in this case, I do agree with Rubio. It is unlikely that we're going to see a massive change in the negotiation context, but we do have some things that are concrete and that are on the table for the first time, perhaps, from the Ukrainians. Now, it is a concession to agree to a ceasefire by air and sea. That is something new. We haven't heard this from Ukrainians, at least publicly, before. We know that this proposition of a partial ceasefire is something that was designed not only by these very experienced diplomats that we're going to see on the ground today in the conversations, but also lockstep with European partners. We know that this is something that was discussed both in London and then in Brussels last week. So we are seeing the Ukrainians actually go a little bit further, suggesting a potential partial ceasefire, air and sea, that is easy to monitor, or well, not easy, let's be clear, easier to monitor than potentially some of the other proposals. But certainly, Ukrainians are not going to be coming to the table today to accept any sort of territorial concessions.
OK, that's interesting. So perhaps we focus on whether there is landing ground on some kind of temporary ceasefire then, because as you say, we've had the Ukrainians saying if there are no airstrikes, if there's no naval operations, then they could be persuaded around some kind of ceasefire with Russia. Russia is saying that they could be open to a temporary truce if they're making progress to any kind of final peace settlement. Does it sound as if there's any kind of landing ground for even a temporary agreement there then?
Well, I think if we listen to what Zelensky has been saying, both in his speeches and last night on his Telegram channel, and I quote, "We hope for a practical result," And I also quote, we are meeting and hoping for the meeting to be absolutely constructive. Now, this is something that is being repeatedly highlighted by Zelensky's team and the diplomats. I think it is possible that the Ukrainians have moved a little bit on this partial ceasefire, but there are other issues about territorial concessions that are just not possible. First of all, 57% of the population thinks any sort of deal is doomed if it includes territorial concessions. Now, that's quite a large number of the population that is very engaged in the war effort and highly armed, and everyone is looking for stability here. Certainly, that is not something that would be stabilizing within Ukraine. And I think the exchange and the retaliatory airstrikes that we saw by Ukraine against Russia, over 300 unmanned aerial vehicles across the Russian Federation and about 70 or so around the Moscow area, these are retaliatory strikes for a week of extensive strikes every single night, 126 last night in Ukraine, but repeatedly every single night, Russia has been trying to strike critical infrastructure and civilian infrastructure. So I think this is also Ukraine showing that it has been very much reserved when it comes to using the tools at its disposal to reach across into the Russian Federation's territory. And so perhaps they're saying we will not escalate in this retaliatory manner if we agree to this partial ceasefire. I think that's a position of goodwill, and that's something that we haven't, again, heard publicly previously.
Olga, walk us through the role that Europe plays, if any, in these negotiations, especially given that any deal needs to be implemented by the Europeans. But there's also an energy question here when it comes to that European exposure. How does that all factor in?
Absolutely. The Europeans are essential right now. European unity is essential right now. Coordination, not only intelligence sharing is essential from Europe right now, but also working with the Ukrainian partners in lockstep. Now, we haven't seen this kind of intense lockstep coordination amongst European partners in quite some time. There are certainly a lot of weaknesses across Europe, across the continent. Actually, energy is one such weakness where previously the need to get cheaper energy resulted in disunity amongst key partners. But we're looking actually what we're seeing is quite the opposite, and we haven't seen this kind of coordination and strength of unity in quite some time. And I think Moscow is paying attention. I don't think Moscow looks at European partners in the same way that it looks at the United States, but it certainly is paying attention to the fact that Europe was able to very quickly not only bring back Ukraine and the U.S. to a negotiation table, but also that there is a concrete proposal that's going to be very difficult for Moscow to reject without looking like they are the ones that are the problem. And let's be serious, let's be very straight. Russia is the problem here. Russia is the aggressor. Russia is the entity that is not willing to cease and stop its war of aggression against Ukraine.
Olga, good morning. How long are we looking at instability in this region lasting? How long before stability returns? What does stability look like? Is this now the new normal, that we are going to see an unstable border between Europe and Russia, and that is just a narrative that we're going to have to live with for generations?
Well, hopefully not, Guy. This is actually what we all hope will not be the result for future generations to come. Now, there is a possibility for both American allies that have continued to have conversations off the record with their European contacts. There have been a lot of diplomats trying to work the phones over the last week plus, trying to figure out what they can do in order not to lose what could be a sustainable deal. A sustainable and just deal that protects Ukrainian sovereignty is one also that protects European security. And I think there are far too many different events that occurred in the last 2 weeks that made it clear that, again, Europe needs to be coordinated on this. If Europe is coordinated and united, the propositions that they make with their Ukrainian partners in lockstep, potentially with American allies that are still having good channels of communication with both Ukraine and Europe, and the UK plays a very important role here, of course, of this bridge between Europe and the United States, that we can have a solution, at least Perhaps not a full resolution any day soon. I don't think negotiations are going to result in a full and just and sustainable peace within the next weeks and months. But I do hope that within the next year or two, we get to a position where we have not only a sustainable peace, but a just peace. But this will mean that the US... Oh, sorry. Go ahead.
Going to have to wrap it up. Professor, great to catch up. Olga Onuk, Professor of Comparative and Ukrainian Politics, joining us from the University of Manchester. Thank you very much indeed. Coming up, Volkswagen expects profitability to remain roughly flat this year. It is contending with muted demand and obviously a worsening trade conflict. We're going to discuss the outlook for this business and what it means for the wider German industrial story next. The Open is coming up. We've got lots of stocks that we need to be talking about as well. All of that is coming next. This is Bloomberg. $15 minutes to the opening trade here in Europe yesterday. Clearly an ugly session. Not exactly a Black Monday, but it certainly hurt, I think, a fair few people. In terms of the narrative of where we're set up this morning, there's not a big bounce coming through, certainly from US futures or European futures. There's a bunch of single stocks that are probably worth focusing on as well. But there's a couple of really clear warnings out yesterday. The one I'm focusing on is Delta. Delta signaling yesterday a slowdown in US consumer spending. That is something that I was paying attention to and probably will be paid attention to in Europe this morning as well. OK, and so we look at that European futures picture and the US futures picture, and it does look a little bit more stable, doesn't it, than the last 24 hours? Green.
But it's green. But perhaps that doesn't do justice to the last 24 hours. So let's just linger, at the risk of putting everyone through a lot of pain, let's linger on some of the pain that we have seen. And we'll bring into the conversation our Markets Live executive editor, Mark Cudmore, who is here in London this week. And we welcome him to the set. Mark, great to see you. So yesterday, Nasdaq down 4%, S&P down 2.7%. Money out of stocks, into bonds. Everybody seems nervous about the growth story. Is that it? Are we done with that worry? That feels like a brave question to even ask.
No, I definitely don't think we're done with that worry. I think there's two different time spans here. One is I am surprised how tepid the bounce has been so far. I thought there might be a little bit more of a turnaround Tuesday narrative in the short term and we get a bit more respite. But this is very much a bounce of the deceased feline variety and it's not really
actually,
inspiring.
It's looking increasingly dead because the Nasdaq futures are now down.
Oh, right. OK, so it's turning even as we speak. Yeah. So I think actually the price action is very worrying in the short term. So it looks like we've even got some more short-term pain. In terms of the medium-term picture, no, there's a paradigm shift happening. There's 15 years of excess valuation in US stocks, which is going to come out over the next couple of years. And so this is a theme that's going to last all year. It's not going to go in a straight line, so we're going to get a proper bounce at some point. But unfortunately, it's not looking like it's going to be one very imminently.
When it comes to the short-term drop, we're at, I think, a 9.5% correction. How low can it go? Is this just something that when we hit that 10%, that's when you see the dip buyers come back in?
I mean, some of my colleagues overnight have kind of suggested that is these arbitrary numbers of 10% seems like enough to kind of come to the market, 30% in Bitcoin. Sure, fine, I think that's what they're trying. But I've said the price action's so negative that I don't think that's where the real levels are. In terms of how much this is going to go, I think in this paradigm shift of disruption of markets, people are going to turn to focus on value. And that means that people are going to look at where stock markets in particular have been valued against their long-term historicals. And there are many stock markets around the world that are still relatively cheap. They are not expensive. And the US market is still very, very expensive. Sure, not nearly as expensive as it was 2 months ago, but there's still a lot of excess valuation to come out of the market. So I think that, no, overall it doesn't stop and US stock market can go a lot lower. And like we saw yesterday, we're going to get brief moments of panic where it's going to overshoot. But it's not overshot yesterday in the long-term story.
Where is the pain?
It's a good question. I mean, clearly tech stocks is where it really is.
No, where is the pain in terms of investors? Who is hurting?
Which group?
Yeah, because it usually ripples out from there. So who's got hit first? Where does it go next?
Yeah, so surprisingly, it does. From my anecdotal conversations and a small group so far, it seems like hedge funds are surviving this, a position for this. They're quicker to play the end of US exceptionalism story. They're quicker to kind of pivot on their narrative. I think retail are really suffering. And you're seeing that both by the names that are getting hurt in US tech stocks, and you're seeing that in crypto sector. So, and I think that's why also you're not seeing the squeeze in, like, for FX, for example, which is much more a hedge fund game. So, like yesterday was an incredible day in tech stocks and crypto, and yet the spillover to other assets. I mean, yeah, sure, we saw a haven bit into bonds, but FX was barely rippled on it, which shows that this is not institutional money that's seeing the real suffering. It is much more about retail.
So yes, the contrast between Tesla down 15% and others in the Mag 7 down 3% or so. That's important, is it? Because Tesla was down with things like Coinbase, MicroStrategy, and Robinhood.
Yeah, I think absolutely. I think you need to keep on targeting those meme stocks. Probably still have more to come out because that sector are getting increasingly desperate. You look at these kind of Reddit boards of the retail sector, and it's quite interesting to get a quick sentiment, judge. And they are certainly panicking. This market's been going buy the dip, and they're suddenly going, I've no more money to buy the dips.
All right, Mark, don't go anywhere because there are a couple charts I want to put on your radar and see how you think about them specifically, because I just want to give our global audience a little bit of perspective of what this drawdown actually looked like. And big shout out to our markets reporter, Valerie Teitel, for walking us through some of this kind of drawdown. Like I said, down about 9.6% when it comes to this drawdown. And we haven't seen this since July of last year. Now, it really got kicked off by a payrolls report back then. But then, as Valerie was suggesting a few minutes ago, this also had to do with the unwind of the carry trade. And you can see the exact same margin when it comes to the stock market. But where does that money go, at least in the short term, at least year to date? And that's where I want to go back to the ETF flows. And you can see that right there. This is a one-year chart of European-focused ETFs. Take a look at those green bars on the right. Investors are investing in Europe, and it's very clear, and they're doing it by the biggest margin since early 2023. Those bars look very similar to what you saw in January and February from about 2 years ago. That's the kind of rotation we're seeing in the market. So I guess the question here is, what reverses that rotation? If you're seeing a pullout from American stocks, does that mean you see a bid into Europe? Now, the easiest signal in the history of markets might just be euro-dollar. And if you do see some dollar weakness, is that a signal for our investors around the world to hop into this market? Well, the correlation, the 40-day correlation between the S&P 500 and the dollar says no. In fact, that correlation is fading quite significantly. So, Mark, let me bring you back into this conversation. If it's not as simple as sell the U.S., buy Europe, which is, by the way, what Citi and HSBC are saying in the last 24 hours. What's the signal to buy back into the U.S.?
I don't think there's anything more than a tactical signal you're going to get there. And I don't think it's just as simply as, sell the dollar and buy Europe. I think it's sell the dollar and look for other alternatives around the world. And I think Europe is the prime beneficiary of that because it has its own structural story. But I think that we are in a self-reinforcing cycle here in terms of that as that money flows out of the US, it does weaken the dollar at the margin. And that may therefore eases financial conditions in other countries around the world. And people start looking back into these emerging markets, these countries that were having to defend their currency, and suddenly they're going to want look in reserve diversification, and that becomes a spiral. I think this is very much like the early 2000s setup, the post-dot-com crash, where I think you can get that cycle of ongoing dollar weakness and benefiting the rest of the world and other stock markets.
Can I ask a question for Lizzie Burden? What's the beta on Europe versus the United States? Is it less than one or is it more than one? I.e., if the US markets continue to go down, is it just a relative trade that Europe goes down less? Is that kind of how I should be thinking about this? Is there an absolute positive trade for Europe? What happens here in terms of the relationship between these two markets?
I think that we're going to continue to see the negative impact of the US equity sell-off just because it's such a big wealth destruction. So therefore, I think Europe will be lower beta, to answer your first question. But I think at some point, when you're probably getting near the end of the structural just deleveraging from the US trade, when you start seeing the relationship change and you start seeing Europe just gain even as US sells off again, that's probably the moment when you're seeing
How
US
far away
getting...
Is that?
As I said, on the longer, a short term, we might reach short-term kind of.
Yeah, but over the course of this year.
But I think longer term, we're a long, long way. The world, look, only at the start of this month, February 3rd, U.S. market share of the global market cap was 50.86%. Now that's a record going back on our data going back to 2004. Admittedly, it might have been higher before, but the last more than 20 years, that's a record. It's now already down below 49%. But important context here: before 2024, in the last 21 years, we'd never seen it above 46%. So we just have this extraordinary excess in US markets that needs to come out. So I think it may not end this year. I think we've got a couple of years of excess investing in the US that needs to come out as the whole world readjusts to what's happening.
Mark, thank you very much. Bloomberg Markets Live Executive Editor Mark Cudmore. Remember, you can get plenty of insight on all of these themes from Mark, the rest of the Markets Live team. MLIV Go is the function to use on your Bloomberg terminal. Let's get stocks in focus then. Joe Easton has a list for us this morning. Joe.
Morning, Anna. So Volkswagen looks potentially reassuring today, with the company predicting a gain in sales of around 5% over the next year. Now we can see that Volkswagen pretty much has tracked the whole sector in terms of the auto sector in Europe lower, and the latest hit coming from the tariff concerns, of course. So as I say, potentially this one looks a little bit reassuring. Then in terms of a sector where we're likely to see weakness is in airlines after that massive drop in Delta in the post-market yesterday, down around 11% as the company warns of weakening demand. And we also saw big hits in United Airlines, American Airlines, all slumping in the post-market. So we're going to keep an eye on the key stocks, particularly the long-haul names here in Europe. So IAG, Lufthansa, Air France. Incidentally, there's a little bit of M&A news coming through around a potential deal for a stake in Air Europa. So a bit more news for that one. Also, potentially some of the short-haul airlines as well. Ryanair, you might see a little bit of a feed through into those as well. Then here in the UK, we've got numbers out of Persimmon in the home builder sector. Now, again, another one that's potentially a little bit better than expected for this one, given the slumps we've seen in their sales. They're predicting that order book is going to start coming back up. House prices doing better as well. We can see it has been a rough few years for this sector. On a 5-year basis, we're down around 38% for the Bloomberg Home Builder Index. So keep an eye on peers, Taylor Wimpey, Barclay, all of those guys could also get a bit of a boost today. Then in terms of analyst ratings, a couple in the UK, Glencore by Berenberg, LSC is an outperformer at Oddo, and the one I like, Burberry, up to outperformer Exane. Keep an eye on that in the luxury space today.
OK, Joe, thank you very much. Joe Easton with a briefing on some of the sectors and the stocks that we are going to be watching. In terms of the European futures picture, then, we have been tracking that, looking like a bit of a rebound this morning, and that continues to be the case. Euro Stoxx 50 up by 0.7%. Nasdaq futures flat, actually. E-mini's only up a tenth. So we'll see how this European bounce back goes if it tries to go it alone. This is Bloomberg.
Tuesday morning. I'm sorry, I'm going to talk about Monday for a moment. I know a lot of people probably wished I wouldn't, but I'm going to. So let's just talk about kind of where Europe went out and where the US finished. So Europe goes out here. The US markets continue to roll over, but there is a little bit of a bounce towards the end of the session that kind of net probably means that actually from a European starting point this morning, we're relatively neutral. There's a bunch of sort of single stocks that I think are worth focusing on. US futures have picked up a little bit since then, so that's worth focusing on as well. And really, that probably leaves us with a position this morning that we are looking at something of a bounce in Europe, but it doesn't look like a kind of a big bounce. And that, I think, probably is a little bit concerning.
I might be jinxing it. It's starting to feel like a turnaround Tuesday. But, Guy, we looked at this in the futures picture yesterday, and we saw a similar green on the screen. The open changed everything when it comes to that sentiment change. But to your point, you are seeing that bounce higher by 0.7% on Euro Stoxx 50 futures. A lot of that green on the screen, Anna, focused over in the DAX. But the notable laggard is the FTSE 100, only higher by 0.2%. I wonder if that's a pain point in just a few minutes.
Yes, and could speak to the sector exposure of the different indices, couldn't it, Critty? Let's talk about some of the sectors and the individual stocks that could be on the move this morning. Guy's been flagging the aviation sector. We'll keep an eye on that after that warning out of Delta yesterday. Really quite negative on some of the dynamics in the US markets. We'll see if there is read across into the European space on that front. VW also in focus. We had numbers out from VW and some of the commentary coming through from the likes of JP Morgan saying that guidance looks conservative is the name what they say the outlook looks, even if the results look fairly strong. HelloFresh could be interesting. That could be weak. Morgan Stanley talking about the weakness there. JP Morgan also talking about weakness in those numbers, Guy.
Yeah, let's look at defence stocks as well. Tom McKenzie's interview with the Greens, really significant this morning. Let's give you a market open. It's time for the opening trade. Let's show you some figures, give you an idea of what is going on. As Critty's been highlighting, a little bit of underperformance over the last few days from the FTSE 100. It opens in negative territory this morning. I think the next few minutes are going to be really interesting. We really need to wash out the back end of the US session, what we've seen overnight maybe, and get a more clear picture of where Europe is going. And the initial indications are quite negative. But look, we don't have other markets open yet, so the IBEX opens negative as well. So this turnaround Tuesday narrative doesn't appear to be there, but the CAC opens positive. That maybe changes the narrative a little bit for the Stoxx 600. So we pick up a little bit, so we're flat. But flat enough, I think, is the key question this morning, really, to kind of change the sentiment, which was so negative yesterday. The IBEX is struggling a bit. The CAC has opened positive. We'll see what the component parts look like there. We're going to wait, I suspect, for a few minutes for the DAX to get going this morning. The SMI as well well. We'll see what they bring to the table in a few minutes. But at the moment, a very, very flat open from a European perspective this morning, with airlines under significant pressure, Chrissy.
Absolutely, and you are starting to see that show up. IAG, for example, right out of the gates, lower by about 4%. Let's talk about the upside, though, and where we are seeing those spots of green. A lot of it, you mentioned that kind of outperformance in France. You're seeing it, a lot of it driven by Schneider Electric. I'm seeing a lot of tech names outperforming this morning, which is interesting given that the underperformance of yesterday's session, a lot of that was driven by the tech space on both sides of the Atlantic. So, Anna, seeing a little bit of that, perhaps, element of turnaround Tuesday this morning.
Yeah, a little bit of a turnaround. As you pointed out, Chrissy, underperformance in London. We do see the CAC 40 up by 0.6%. The Stoxx 600 overall, then, net is flat, but we're waiting for the Xetra DAX to open. I suppose it's worth remembering that we were driven a bit by some of these US themes yesterday, but we were also driven by nervousness around the German deal and the ability of a new, or rather legacy German administration to get through some of the defence and infrastructure spending plans they have. Maybe that looks a little more likely this morning, given that conversation with the Greens, and so maybe that helps us make some gains. Having said that, though, the Stoxx 600 now down 0.1%. So, yeah, travel and leisure is certainly one of the things we're watching on the downside. That sector down by 1.3%.
So, IAG, owner of British Airways, Iberia down by 6%, EasyJet's down by 3%, which is interesting. It doesn't have any US exposure, but it's a kind of broader narrative in the space. Lufthansa's under a little bit of pressure as well. Lufthansa is down 2.8. This is Ed Bastian's work over at Delta, downgrading forecasts yesterday. There is a conference taking place in New York today, an airline conference. I suspect it'll be interesting to see whether we get others coming out and telling similar stories in terms of the US consumer, maybe just becoming a little bit more cautious, particularly maybe at the front of the plane, which I think would be really interesting. But Ed did talk about the fact that it was transitory. He sees this hit at the moment as being transitory. I wonder whether it's too early to tell whether it is going to be transitory, Chrissy.
I'm a little triggered by the use of that word three
exactly.
times in one sentence. I'm having a little bit of PTSD there. The DAX is officially open, higher by about 0.3%. Interesting, though, it is lagging the French index this morning by a decent margin. A lot of the outperformance in France driven by one name, and that, of course, is Schneider Electric. So we're going to keep an eye on what those tech themes do to the broader markets. In the meantime, let's get a true expert kind of a take on what's going on. Peter Oppenheimer, Chief Global Equity Strategist and Macro Research Head of Europe over at Goldman Sachs, joins us around the table. Peter, pleasure to have you on the program.
Thank you.
Do you buy the dip?
Not yet. I think this is, we had very extreme positioning and really quite a significant degree of optimism running into this correction. And I think probably that has a little bit further to go. Essentially, though, economies are growing, albeit perhaps a slower pace than people were expecting at the end of last year. And we are going to get some interest rate cuts, and that will, I think, limit the extent of a drawdown. But I think we still probably have some more volatility to come.
You talk about extreme positioning. There is a question that around a lot of the outperformance in Europe that we're seeing, it's really short covering on the European positions, not actual fundamental outperformance. To what extent is that narrative true?
Well, I think there's more of a shift, an inflection point that favours Europe relative, at least, to the US, and this is a topic that we've been discussing really all year. And part of that, I think, comes from the slowdown that we're seeing in the US economy at margin. It's still growing, but at a slower pace. Our economists have downgraded their forecast for the US. We're now below consensus for the first time in 2.5 years. We're expecting a growth rate of about 1.7 in the fourth quarter, year over year. And that's below trend, but still okay. But in addition to that, of course, we've seen some real pressure coming in the biggest tech stocks in the US. And they have such a big weight in the US market, is dragging the US down more than other markets. And of course, on the other side, European growth expectations have been edging up from a very low base, partly triggered by optimism over increased defence spending, as you discussed earlier. So I think there is a genuine fundamental inflection point that's happening, supporting Europe, at least in a relative sense.
And just lingering on that inflection a little and sort of dissecting it a bit then, Peter, thinking about the US and where the pain is, where the pressure points are. We were talking to our colleague Mark Cudmore earlier, and we were joining the dots between various retail favourites. Tesla down 15% in one session, Coinbase, MicroStrategy, lots of these stocks that tend to go together, attract the same kind of crowd. Is that where the pain is? Is this a retail pain story? Is there a lot of will there be institutional pain from the selling that we saw yesterday in the United States?
I think it's both. I mean, it's true that there have been favoured retail stocks and they've been down quite sharply, and that will have an effect of tightening financial conditions and raise the concerns that are being reflected in market pricing about a slowdown in growth in the consumer. But also, if you look at favoured positions from hedge funds, they've taken quite a lot of pain as well. And we have to also recognise that context matters here. There was a huge amount of optimism, not only about the US economy, the leading tech names in AI, but also the whole concept of US exceptionalism and animal spirits. And those are really being, I think, tested right now, and that's triggering this pain, and therefore I think some forced selling as well, which is exacerbating some of these moves.
Yeah, and what kind of volatility are you bracing for? I was reading Morgan Stanley yesterday talking about in the first half of this year they think the S&P could be down 5%, but then there could be a rebound. I mean, do we have any visibility about where this seeming uptick in volatility is going to take us?
Well, we've already seen a correction of more than that, and let's be clear, it's been a long time since we've seen a correction of 10% or so. I don't think that would be at all surprising, given the extent to which markets have risen. Bear in mind, in the last 2 years, the US equity market has seen a return well in the 90th percentile of 2-year distributions over a century. So it's seen extreme upside without a correction. And I think it's normal, as people begin to question some of the confidence and assumptions that underlay that strength, that you get a correction. 10%, I think, is perfectly reasonable. Will it be a lot more than that? I would doubt it, because fundamentally we are still seeing economic growth and rates will come down. And that combination is not typically conducive to more serious bear markets.
What happens if that economic growth is questioned, though? I bring up Delta this morning. Delta is highly exposed and has real-time information related to the US consumer, particularly the high-end consumer that is spending on travel at the moment. It's just downgraded its forecasts. Right. It is telling us that the consumer is becoming more cautious. The consumer, he or she, doesn't know kind of what the outlook looks like. If that is seen elsewhere, does that call into question that economic certainty that we've had that has underpinned this market?
I think so. So, again, when you look at the period going into this year, the confidence in economic growth, particularly in the US, was unshakable. There's a very, very strong consensus that the US economy will continue to grow at a rapid rate, rates will come down. And really, markets react to changes at the margin. So if you start to see some evidence that the economy is slowing, that the consumer is tiring, then, of course, some probability of recession has got to be priced in. That means that from the starting point of valuation, some degree of adjustment has to happen.
What is a S&P? What is a level that is consistent with a recession?
Well, in terms of multiple, or in terms of...
Just in terms of just overall level. Well, where would we get to in a recession? Where do you think we would end up?
Well, in typical recessions, and again, they vary in terms of magnitude and length, you would expect the S&P to be down at least 15 to 20%, and other markets typically more than that.
Right.
But we also have to note that, of course, the US equity market came into this correction
from a very high level.
High level of valuation.
So we would assume that that number would be greater?
It could well be greater than that, yeah. But I think it's also important to say that when you look at the distribution of the composition of the US equity market, the biggest stocks also are unusually defensive, given that they have so much cash and they have very strong balance sheets. So I don't think valuations are going to normalise to long-term averages. But again, the sort of correction we're seeing at the moment is not at all surprising as you start to see some degree of adjustment downwards in the confidence of US growth. And that also feeds into, of course, other markets as well.
Peter, where does the currency impact fall in this? Because when we see technical corrections like this in the States, usually the dollar correlation is pretty high, and that creates this kind of fund flow from Europe, from China, et cetera. We're not seeing that this time around. And as we speak, by the way, we should mention the euro-dollar has retreated after testing last week's highs. It's now at 108.88. There is a euro bounce in the currency market. How does that affect the equity market on both sides of the Atlantic?
Well, I think that's a reflection, actually, of the degree of consensus coming into this year. That, we had our own survey of investors at our strategy conference, which we do every year, and the highest proportion ever thought that the US would outperform, that the dollar would go up, that technology would be the best performing sector. And by the way, the lowest proportion that we have surveyed in the number of years expected Europe to be the best performing market. And I think, again, that reflects the degree of consensus coming into this year. And many of these are unwinding at the margin at the same time. And it's understandable that if people start to question the strength of US growth, then at the same time the dollar's going to weaken a bit, and and I think that's again a consequence of this sort of inflection point we're seeing in expectations.
And in Peter, then if what we've seen is a questioning of US growth and questions about that US exceptionalism, and a lot of that does seem to be attached to the tariff conversation, but maybe not all of it. Is it right then that US tech should be punished quite so much? I appreciate they rallied a long way, so they're vulnerable in that sense. But are we in danger of overselling US tech if actually the tariff pain is going to fall elsewhere?
Yeah, I think fundamentally US tech is in a very strong position. We expected, along with diversification broadly in assets, that you'd see diversification benefiting technology itself, so a little bit of a spread outside of the biggest hyperscalers, and that is beginning to happen. But, the other thing that sort of changed in the last couple of months is that the competition in the AI epicenter is starting to increase, and that again is sort of raising questions about the dominance that these companies have and the validity of their ramp up in capex spending. So I think fundamentally they're very strong and they have very good longer term opportunities, but the confidence in their dominant position had got too high. And alongside that, their valuation's a little bit too extreme, and that adjustment is what I think we're seeing at the moment.
Peter, the question that a lot of people watching this programme this morning are going to be asking, listening to you, is where do I hide? Where do I go next to protect the gains that I've generated over the last few years?
Well, when we talked about the benefits of diversification, which has been a big theme of ours this year, partly because of those extreme valuations in equity space, we also talked about diversifying across asset classes, and we've been overweight of equities and bonds. We wanted to be overweight of equities because they typically do well if economies are growing and rates are coming down, but we felt that bonds would be a good diversifier.
And that's working.
Those growth expectations were tested, and that's working. So I think spreading across asset classes makes sense. Within equities, spreading across regions and indeed across sectors is paying off for the
Is that a relative trade? Like if I go to Japan, is it am I going to outperform but still have a negative number on my P&L at the end of it? Give us the...
If you get a correction and it's led by the US and it's 10% plus, it would be very unlikely that other equity markets would be going up.
Right.
So it becomes a relative trade. I think that's right.
Fair to say.
But it's still true that diversification would help in that context. One of the other ways of diversifying, of course, is looking at low-vol stocks, and low-vol stocks are outperforming sharply. So strong balance sheet, high cash generative, relatively defensive parts of the market are actually seeing some relative benefits.
Cash?
And cash is also yielding a reasonably attractive amount in most places, and it's it's a very changed world in that sense as well, and that becomes part of a diversified portfolio strategy, I think.
Peter, always great to see you. Thanks for spending so much time with us
Thanks.
this morning. Peter Oppenheimer, the Chief Global Equity Strategist at Goldman Sachs. Quick look at what is happening with the Core 6 this morning. As we've already mentioned, Schneider looks like it's a significant outperformer, and what we're watching at the moment is certainly some outperformance coming there. It's interesting, you've got a left and a right to your screen this morning. It's a game of two halves out there. Novo, LVMH, Ferrari under a little bit of pressure, ASML and Schneider in the tech space actually both doing relatively well, but there's some other big movers out there this morning that are worth focusing on. Joe Easton's got the details of those.
So we are seeing some big drops in the airlines here in Europe, guys. Significant underperformance feeding through from that disappointment around Delta Airlines and also the drops we saw in the US and Asian peers overnight. So IAG among the worst performers, and take a look at Air France, down 5% on that one, and even the short-haul airlines with not much UX exposure getting a bit of a negative read-through. EasyJet declining, Ryanair looking a little bit weak as well. Then over in autos, VW was a little bit stronger, and I actually saw a bit of a trading halt coming through on that one a few moments ago. We'll see if it's still moving. It is ticking higher, up 3.5%, extending the gains, reassuring on some of those numbers in terms of the sales outlook for the German automaker. Then here in the UK, we've got those home builders. Been a brutal couple of years for that sector, but we are finally seeing a bit of positivity. We're seeing Persimmon today talking about better than expected orders and potentially even house prices starting to stabilise. We've got the Bank of England next week, of course. That'll be crucial for the sector given the potential outlook for rates, so that's going to be key. But Persimmon boosting its own stock and peers today. Then a couple of big German decliners. HelloFresh still not selling enough of those packaged meals. Now that has another sales warning. It's had a swathe of sales warnings over the past couple of years, and we're down 12% in the German mid-caps today. Really hit hard for HelloFresh. And in the larger cap German space, Henkel, a massive company, around a 30 billion market cap in terms of one of the bigger stocks moving today. This is exposed to the household products. I looked up their brands. It's Right Guard deodorant and also some of the washing powder as well, but a warning on their margins today, hitting that stock pretty hard. One of the worst points decliners today. Then a couple of rating changes. Prysmian, this one has been caught up in the sell-off in data centres, exposed to data centres. It's electrification. Probably completely pronounced that wrong, but it's similar to Schneider Electric, Siemens Energy, sold off recently. UBS today says you should be buying into that sector. And finally, Burberry going back to its British heritage, according to Exane, under the new CEO, and they reckon that is the most successful period, or it has been in the past, when they focus on the traditional British scarves, those tartan scarves. They recommend buying Burberry. We're rising 1.6% on the luxury goods maker in London this morning.
Joe Easton from our equities team, we thank you so much walking us through some of those early movers in the European session. It is the most wonderful time of the year in that there is daylight savings, which means we get to do a little bit more of the U.S. pre-market as well. If we're talking for elements of Turnaround Tuesday, here's maybe where you might find some, specifically in the tech space. You're looking at Tesla shares higher by about 2%. Now, remember, Tesla's been down 45% year to date. Donald Trump also in the last 24 hours saying he might just buy a Tesla. So we'll see how much of that sticks into the U.S. Open. NVIDIA shares higher by 1% as well. But Palantir, which has been part of the AI trade, not getting in on that rebound, down about 1.4%. A couple of earnings stories we've got our eye on as well. Guys been mentioning Delta quite a bit in terms of the consumer read-through, that warning from Ed Bastian as well. Delta shares down a whopping 10%. And it's not alone. Oracle also missing their earnings yesterday after the U.S. bell, down about 1.2%. We're going to dig into the outlook, the consumer story, the business investment story, and some of these other U.S. movers shortly. Stick with us. This is Bloomberg.
Tuesday morning, how are you feeling? Let's take a look at the markets and get an idea of what is going on. As you can see, it's a mixed picture in Europe. The US is bouncing around all over the place. We're trying to get an understanding of kind of where we are going to be taken today. There's a lot of data coming out today, which is also interesting too. You've got NFIB coming up a little bit later. A little later, you're going to get jolts as well. Corporate profitability is a big factor in all of this as well in terms of what we're watching. So US futures, a few minutes ago were negative. Now they're positive. Who knows what's going to happen over the next couple of hours. It's only 4 hours difference between London and New York right now. Look, the other story you've got to fold into the narrative this morning, I think the Delta Airlines story is really significant. Ed Bastian out last night cutting profit expectations for the first quarter. He's citing weakening travelling demand. He's talking about economic worries. He's talking about uncertainty. You've got a conference taking place today. Are others within that space going to be saying a similar thing? Oracle also slipping in after hours, like not as much. The tech giant reporting disappointing corporate results. Sales profit forecast for the current quarter, a little short of estimates. Again, what does that tell us about what is happening in the tech space? Let's try and get an understanding of what is going on here. Valerie Totel is sitting nervously next to me, trying to...
She has an understanding.
Does she? Excellent. Cool. Wow, tell us more. The earnings. So I'm slightly obsessed with Delta, which I always am. I think Ed Bastian is telling us a really interesting thing at the moment. He's saying that there is clearly a hit to confidence.
Yep.
It's showing up already in terms of bookings. He's saying it's transitory, but transitory is a kind of fuzzy word to me.
No, I think what we heard in the after-hours earning reports out of the U.S., it just goes to almost, double onto this narrative about the U.S. consumer pulling back, Delta being that one. It's adding to what we've heard from big box retailers already, where, fourth quarter was okay, but they gave cautious guidance for the year ahead, given Target, Walmart. Home Depot, Lowe's, even add Macy's into that, all given this cautious guidance. So we haven't heard, I guess, anything from the earnings reports that would necessarily buck that trend. If anything, Delta just added to it yesterday. And then with Oracle, that's also, again, aligning with the recent narrative that if you want earnings growth in tech, it's not going to be in the U.S. It's going to be in China. So again, earnings growth coming from the East instead of from the West. Again, Oracle kind of aligning with those recent narratives. So we haven't seen anything necessarily to buck the recent narrative about worries about a U.S. consumer. I mean, what could spur a reversal? I think we're still asking ourselves these kind of questions.
Yes, and I wonder, what does a reversal look like? Because we see U.S. futures up just tentatively this morning, and they have, to Guy's point, been all over the place in the past hour or so. I mean, do we have any sense of what is going to draw any kind of line in the sand, or is this just the new normal? We just get used to these, big moves.
Well, look, I think there's two sides to what could spur a reversal. We do have CPI tomorrow. If it comes in soft, maybe we're more confident about a Fed cut in May, and that gives some bounce to the equity market. But then you also have to take into account the politics side. If Trump is not backing down on this tariff narrative, we need to hear more about these promised tax cuts that are going to come. Like, I don't think the market is going to want to wait until the fourth quarter of this year to have more certainty on these tax cuts.
And he is
coming.
meeting business today, so maybe, as you were saying earlier, maybe that's a line he pushes hard to try and counter the negative.
Yeah, exactly. Does he have the Republicans on his side when he pushes for that, or does he have to show that he has tariff revenue in his back pocket before pushing for that as well?
The irony is that aren't corporations supposed to be lobbying the government? It kind of feels like it's the other way around at the moment. But to your point, a lot of that tariff story has been showing up in the FX market, specifically now this morning. Perhaps it's not a tariff story, but certainly some FX volatility when it comes to euro dollar.
Well, I think this is more, again, this narrative that fiscal spending is in the back seat, right? We're seeing continued outperformance of the rest of the world, be it here in Europe. European stocks continue their outperformance. Euro reaching 109 just in the last hour. Add to that, China is still stimulating as well, driving equity gains in Asia. The one outlier is the U.S. The U.S. is not pushing a big fiscal spending package through
that was the last few years. That's
exactly.
That's where we are now. We've had that. Now
was
it's
the Biden data.
Precisely. I think we can blame the euro move partly on Tom McKenzie this morning. I think he has some degree of responsibility.
I'm always game to blame Tom McKenzie
for most things. Yeah. This morning, I think it's the euro dollar.
That's a credit. credit Tom McKenzie for that strength. I'm sure a lot of Europeans are grateful to him this morning. Bloomberg's Valerie Teitel walking us through a little bit of everything from the earnings story over in the States to the bond market to the currency market as well. Coming up, we're going to stick to the corporate story, stick to a little bit of what's going on in Germany as well. Volkswagen shares rising after reporting their earnings. It comes as the German automaker positions for worsening trade conflicts. We're going to hear from the CFO of the company shortly, and followed by a really interesting conversation on the auto story, the tariff story, perhaps a little bit of the currency impact as well. Those conversations coming up next. This is Bloomberg.
Welcome back to the programme. Let's have a quick check on what's happening with the Volkswagen share price this morning. It is up by 2.5%. We see the market responding quite positively to what we've heard from Volkswagen in terms of their earnings story. The Volkswagen CFO, Arno Antlitz, spoke with Bloomberg's Oliver Crook. That conversation about US policy a short time ago.
We feel already like an American company. Look, we operate a huge factory in Chattanooga with thousands of people there. Volkswagen Group of America employs more than 20,000 plus people, create safe and well-paid jobs. We invest in South Carolina. So we think these should be taken into account when talking about tariffs and Volkswagen and talking about the U.S.
But if you were to get 25% tariffs, and I know that it's too early to say, but again, it's not a zero. It's very far from a 0% chance. Would it mean a bigger footprint of manufacturing within the United States for you?
Let's not speculate. And as said before, we want to grow in the U.S. And we set up some initiatives already, like Scout project, like more projects to come for brand Volkswagen, and this is what we've been taking off.
And trying to look a little bit further into the future, I know it's sort of hard to determine right now. When do you think you could get, for example, margins back up to, say, 7%? Is that a 2026 project? Is that a 27 project?
Yeah. Now, I've told you some of the initiatives we launched. We launched 30 new projects, 30 new vehicles last year. We will launch 30 new great vehicles this year, and I think you drove yesterday some of these great vehicles. And we are up to a significant positive trajectory towards 2027. It's too early to say. We decided to give you an update on the German AIA.
And then in terms of sort of, because this is something that's very interesting to me as a CFO who's really in charge of allocating capital in a time of radical uncertainty, where is it for you certain to allocate that capital? Where, in terms of, because we have all this unknown about global growth, tariffs, where are you certain that those investments are going to pay off, and where are you putting that money?
Our capital allocation strategy focuses a very clear strategy. Look, we want to keep our market share in Europe. We are the biggest player in Europe, 25% market share. We want to re-engage in competition in China, 2026, 2027 onwards, and we want to grow in the US. And our capital allocation follows these strategic topics, and we have a very clear path behind that.
And then you've lost some market share in China. You've guided towards that about 2%. Are you confident that you will not lose any more market share? Are you now, do you think, stabilized in China for 2025?
The good news about losing market share in China in 2024, it's exactly as predicted and as we discussed that the year before.
Yeah.
So I would say we gave up market share because we tried to find a good compromise between prices and margin on the one hand, and volume on the other hand. And you should expect some more market share loss in 2025. And then 2026, I would say second, third quarter 2026, when we have all the technology in place, tech partnerships, autonomous driving, in-car infotainment, LFP battery, then we re-engage in the competition, let's say second half 2026.
You were so accurate in predicting how much market share you would lose last time. Do you know how much you would lose now? Is it another 1%, 2%?
1% is not a bad estimate.
And I'd like to get your sort of a reaction to some of the developments we've had here in Germany. We have not quite a new government, but we have one in the process. When the chief financial officer of Volkswagen wakes up and sees the headlines that the government is looking at reforming the debt brake, pumping potentially up to €1 trillion into the economy, what is your reaction to that? And how do you think it will impact sort of consumer sentiment and the broader economy in Germany?
First and foremost, I'm not in a position to give the German government advice.
No, but you have to adapt to what they do.
Yeah, exactly. If I look at the initiative, for example, for defense and the initiative for infrastructure, I think these are the right initiatives to the right time. But I would sleep much better if they would be accompanied by some structural reform, by also some savings in other areas to finance these projects.
Yeah, go on.
No. Look. I feel a little bit reminded like Volkswagen worked in the past. Look, we always, we had fixed cost problems in the past, and Volkswagen tried to outgrow these fixed cost problems with spending. And from my experience, you have to do your homework on the cost base first, or at least in parallel. Do structural reforms, as we did with Volkswagen, and then you can grow profitable. And this should be the way forward for our economy as well.
You can't outgrow your problems. You need to do the hard work of structural reform. So says Arno Antlitz, Volkswagen's CFO, talking about Volkswagen, but also suggesting that might be good guidance for the German government if they're listening. Guy, really interesting conversation there. And Volkswagen telling Ollie Crook then that they already feel like a US company. And you wonder how many others in the sector are having similar thoughts or wanting to express similar sentiments.
Yeah, it makes life easier, doesn't it, if you are a US company and you don't necessarily face the tariff story that maybe others will face. It's a tough line to walk, though, when you're looking at a European story that maybe is recovering. Let's stay with the space, figure out what is happening a little further down the supply chain, but an important part of the supply chain, literally where the rubber meets the road. Andrea Casalucci is the CEO of the Italian tyre maker Pirelli. The stock is up this morning, circa 0.5%. Good morning. Nice to see you. The proposition from Pirelli over the last few years has been go up the value chain. You are targeting a higher value end of the tyre market. In an economy that is starting to see jitters and concerns and a global economy that is slowing down, does that make your business less cyclical? Does that protect you in some way from some of the volatility that may be coming towards the global economy?
Yeah, you are fully right. Look, 77% of our sales in Pirelli are concentrated in the high-value segment. Pirelli is leading the high-value segment in the tire industry, and high-value is a much less cyclical business. And so we feel more protected against the high level of volatility we have in the market today. And we have a strategy that looks for value, really, and that's what we focus on.
Does the higher value segment also protect you in the tariff story? Does it mean that your products are more sought after, consumers are more willing to pay a higher price, potentially post-tariffs? How are you thinking about how tariffs could impact Pirelli?
Yeah, of course, tariff will impact in case will come, but we have two important elements. First, we have a mitigation plan to protect our supply chain flows against potential tariffs. And second, as you correctly said, the high-value segment is more protected because we will be in the position to increase price in case and to protect the final value. Also because in the tire industry, the capacity, production capacity installed in the United States is far below the total demand of the market. And this is creating the risk of inflation in case, but on the other side, the opportunity to rise price in case of tariffs.
What does that, you talked about the capacity there, what do plans for the future investment in the United States look like?
Yeah. Look, United States for Pirelli is the most important market. Today represents 20% of our sales. And we invested a lot to support the growth in the United States in the last years. We invested in terms of new products dedicated for the U.S. consumers, in terms of growth with the American car makers, where today we have the same market share we have with the Europeans or the Chinese, but also we invested a lot in terms of distribution and brand. We partnered since 2011 with Formula One as sole supplier, and the popularity of Formula One in the United States is growing. They're doing an amazing job, and this is also supporting brand consideration and brand awareness. What we still miss is more capacity installed in the United States. And this was part of our industrial plans since years. And we have small plants in Georgia, and we want to grow more. This was part of our plan before, and today, with the risk of tariffs, is becoming even more important and urgent. So we are accelerating in this direction.
To what extent, though? You're talking about Georgia, but you're also talking about partnering with some of the American car makers, largely based in Detroit and in other parts of the country. When you talk about accelerating that plan, talk to us about, first, the margin of expansion and perhaps the diversity of location within the United States.
We are evaluating. Today we are open. We are accelerating the evaluation with the local authorities and with the local institutions, and I'm confident that very soon we will be in the position to announce an important investment in production capacity in the US.
Andrea, your vice chair recently talked about a material investment in the United States, and Kriti talked about the operations in Georgia and then other operations in Detroit. Help us get a sense of how material are we talking here?
Look, I said 20% of our sales comes from United States. Out of these 20 today, no more than 10% is produced locally. And so let's give you the feeling of the gap where we can grow. Of course, we will never arrive at 100% produced locally because we have a global supply chain. We produce tires for the United States in Mexico, in Brazil, in Europe, and this will remain the case. But we need to grow. And how much this is too early to tell you, but we are in the direction of having a very material investment in the United States.
So maybe not quite doubling then, not.
It's early to tell you.
Too early to say.
We will come back.
Okay. We're talking a lot about volatility in markets these days, and one of the areas we see quite a lot of volatility is in the euro. The euro is a lot stronger once again this morning. It headed up to 109. Tell us how that figures on your radar. How much impact does this have on a business like Pirelli?
Look, we have been negatively affected by the forex in the last 4 years.
By strong dollar.
Yeah, because of that. But to be honest, we have been able to grow in profitability and cash conversion year after year. So I feel that we will be in the position to deal with the volatility of the exchange rate.
You're still the sole supplier in F1. You're going into MotoGP bikes 2027. Talk to us about the effect that had. What does going into MotoGP, what does that deal done from 27 mean? How does that translate into what you do, the evolution of the product, but also the evolution of the bottom line for the company?
Look, being Pirelli the global leader in the high-value markets, and let me say, we just do this. This is what we do. We are the only tire player in the industry 100% focused on the consumer business. It means motorbikes and cars, leading the high-value market. And so staying in the motorsport for us is of paramount importance because of two reasons. First, we learn a lot from the competition, the track racing, because it's an open-air laboratory. Every day we learn something, and then we transfer the technology into the day-by-day activities on the normal tires. Second, powerful marketing tools to communicate, position the brands all around the world. This is the case of the relationship with Formula One, where we are sole supplier since 2011. And that will be also the idea on the MotoGP. We still need to finalize some details in the contracts, but has been announced by Dorna that from 2027, Pirelli will be the supplier of the MotoGP, the sole supplier.
What needs to be sorted out? What needs to be sorted out?
Details.
Details. It's going to happen.
It's going to happen. It's going to happen.
I want to circle back to the relationship in the United States. You talk about how it's such an important market for you. You also talk about increasing some of that kind of exposure with the U.S. automakers. In those conversations, what have you heard from those clients when it comes to that supplying relationship? What are they worried about? What are they asking for?
Yeah. Look, the feeling I have is from all around the world, the car makers today, they need support in terms of innovation and capability to help them in managing the transition into new powertrain, electric vehicle, plug-in electric vehicle, and also the new software-defined vehicle concept. And so what Pirelli can provide to our partners is capability to innovate. Connected tires for us is of paramount importance, the introduction of digital and connectivity into the tire, becoming smart and being able to communicate with the control units of the car and becoming a protagonist into the vehicle dynamic. That's a way. Sustainability is another way. Reduction of CO2 emission, percentage of bio-based materials.
Andrea, forgive me, that's an expensive prospect for especially American car makers, I'm sure German car makers as well, that are looking to launch cheaper models. How can you help them with that goal?
Yeah, Pirelli is not really targeting cheaper models or the synergic segment. We really focus on the high end, and what we can do for our partners and customers is really to support them in innovation, because at the end of the story, innovation and technology will provide also efficiency or pricing power to our customers.
So you're focused on places you have pricing power. What do you make of what's going on in Germany? Big change, big fiscal spend. You're focused on the consumer, the high-end consumer. VW CFO gave a little advice to the German government. What do you see in front of you in Germany?
Well, it's a big change. It's really a transformation. But I'm really confident that the European car makers, the German car makers, will recover the pace of growth. We are with them. We will do all our best to support them. But in Europe, we have nice cars, sustainable, driving pleasure. I'm fully confident that they will be able to recover speed in terms of transition into EV and, again, innovation, technology, and connectivity on the cars towards the journey of the autonomous driving. Nevertheless, it's a tough momentum, and they lost market share in China, that is a matter of fact, and this will be more complicated to come back to the previous market share. But I'm fully confident that they will recover speed and in Europe as soon as possible.
Okay, recovering speed seems a good place to end it on. Andrea, thank you very much. Thank you very much for joining us. Andrea Casalucci, the CEO of Pirelli. Let's have a quick look at the Volkswagen share price. We started this part of the programme with a conversation with the CFO of Volkswagen, and we've had earnings out from Volkswagen this morning. The share price moving higher, up by 1.6%. We're joined now by Bloomberg's Oliver Crook, who was speaking to VW CFO earlier. He's at VW's headquarters in Wolfsburg in Germany. Oliver, let's start with the earnings story. Something in there pushing the stock higher today, then?
Yeah, so listen, I think that overall what we got from the earnings, and this is what sort of the market is pushing the stock higher about, is that basically it beat on a number of different metrics. This was never going to be a standout, exceptional year. The bar was fairly low going into it. And at the end of the day, Volkswagen was able to outperform, and they're starting to buy in a little bit to this idea of their turnaround, and really investors buying into the theory. Because really last year was about making a lot of difficult reforms. It was about those job cuts, about the reform over and all those negotiations with the union. And in terms of what we got in terms of the actual figures themselves, you know, the operating result was down 15% last year. Revenue was basically dead flat. Volumes were down quite a little bit. And the operating margin came in at about 5.9%. That's down from 7% the year earlier. And they've guided this year to about 5.5 to 6.5 percentage points. But again, that is with a huge amount of uncertainty on the horizon, everywhere from tariffs to a sort of global slowdown. And also, of course, they still need to spend huge volumes of money to get this transition into the electrification, but also huge outlays in terms of the software and sort of recapturing market share over in China. Overall, what you saw in every single segment, from the cheap cars to the medium-range cars to the expensive cars, was margin erosion. But again, what they're really sort of trying to pitch to investors here is that they're at the starting line in 2025, and they're really sort of gathering pace going into next year.
Does that include China, Ollie?
Unfortunately, it does not include China. I think this is going to be another year of sort of Chinese pain for Volkswagen as far as they're concerned. And you think about the different challenges that they've got there. Obviously, there's the big macro picture in China. Overall, the market not doing very well. We should talk about also the luxury recession that's happening in China. That's not just in the auto sector. That's, you know, for the likes of LVMH and others. But they're really feeling it at the Porsche side and the higher end models. But really, it's an overall story in China. The other thing that they're really needing to do here, and you saw I sort of demoed some of these sort of internal parts of the car that are basically designed just for the Chinese markets. Driving a car in China more and more feels just like driving an iPhone around, right? It's an entertainment system. It's not all about the sort of performance. This is something that, you know, for a German automaker that's really been historically concerned with performance, is a sort of uncomfortable territory for them. But they've got this Xiaopeng partnership where they're sort of really trying to build that out, and they're really wanting to hit those models and those concepts to hit the ground. And when I was speaking to the CFO a little bit earlier, they said that they lost basically 2% of their market share last year. Remember, they had about 15% of the Chinese market a few years ago. A couple years ago, it was down to 10. Now we're going to say they're about 8. And they said that they expect to lose another percentage point this year. So again, they're not going to have the uplift quite yet, but they're hoping that that will come in 26.
Bloomberg's Oliver Crook walking us through some of those uncertainties around the world for Volkswagen, joining us out of Wolfsburg this morning. We thank you so much. Coming up, we're going to stick with that German theme. Germany's Greens are ready to negotiate with a prospective next ruling coalition led by Chancellor-in-Waiting Friedrich Merz over defense spending. Now, the party's co-leader tells Bloomberg she's hopeful of a deal by this week. We're going to dive into the details. This is Bloomberg. Germany's Green Party says it's ready to negotiate with a prospective ruling coalition led by Chancellor-in-Waiting Friedrich Merz over defense spending. Now, the Greens are demanding tougher rules for defense spending and criticizing the current proposal as too narrow and lacking in ambition.
We're not ready to just give a blanket check and a hand-free for just government spending without any structural reform, without any ambition, without any help for Ukraine. That's not what we are there for.
Okay, but you are, it's clear you are ready to negotiate.
Of course, we have been ready to negotiate since the night of the elections. We have been surprised that there has been nobody really engaging with us seriously, even though it has been obvious that we are needed for a majority. But we have been, signaling from day one that we are ready to negotiate.
Do you think at this point, do you think it's possible, given what you heard from your counterparts and your colleagues in those discussions yesterday, do you think it's likely that we could get a deal by the end of this week?
No, I really hope so. I'm like, the situation is dire in Ukraine. We really need Europe to speed up its own defense spending, but we also need to realize that cybersecurity, there are new attacks on our security, and we need to be in a modern phase of security. And we need to make sure that we have all we need for our own country in terms of infrastructure. We in Germany, we have crumbling bridges. There's a lot to be done. And we need to do this now. And it's unfortunate to see that the new coalition is not ready to tackle the challenges, but just to pour over more money without really tackling the root causes.
The co-leader of Germany's Greens speaking with our very own Tom McKenzie earlier today. Let's bring in Bloomberg's Europe executive editor Chad Thomas for the latest on this deal. Chad, we just heard there from the co-leader of the Greens saying that a deal is hopefully in the works. Talk to us about the likelihood of something that the markets are saying is already done.
Yeah, this seems pretty like it is going to move forward at this point. Obviously, there's still negotiating to be done. But what's interesting in that interview with Tom, what she was saying is no one has spoken to us yet. And I think what the Greens did yesterday was to send up a warning signal to say, if you don't negotiate with us, you're not going to receive our votes. And their votes are critical for them to reach this two-thirds majority that they need, because these are constitutional changes that they're talking about doing. But when you look actually at what the Greens then said yesterday afternoon, the proposals they had, they wanted to make sure that there was specific spending for Ukraine. That is something that the current government and the government that's coming in was already looking at. That seems like something that they should easily agree on. And they wanted to change a little bit where the money was spent, whether it's part of the regular budget or part of a special budget when it comes to defense. But it seems like now things are moving forward. We're hearing that there will be negotiations today between the Greens, between Friedrich Merz's Christian Democrats and the Social Democrats on a way to move forward on this and try to reach some sort of agreement, as she was telling us this week still.
Yes, just briefly, Chad, what does the process, how does it play out from here? I was reading some Deutsche Bank research that talked about the possibility of a constitutional court getting involved if it really went down to the wire. But do we have a sense of how it plays out?
Yeah, well, Anna, they have basically 2 weeks now to get this deal through. That's because the new parliament will start sitting in 2 weeks. And because of the election results where parties on the far right and far left won significant seats, they would not have the two-thirds majority needed to make those constitutional changes, because those parties on the far left and far right have said they won't support this. So really, they're coming down to the wire, and any sort of constitutional court challenge then makes it all the more difficult, which is why they feel they have to get this through as quickly as they can.
Thank you very much, Chad. Bloomberg's executive editor for Europe, Chad Thomas. NFIB data, that's a focus for markets.
NFIB jolts this meeting between business leaders and the White House with Trump involved. Fascinating. Yep. German, the day ahead looks packed.
Ukraine, Greenland even. We'll see where
Portugal.
the headlines come from. That is it for this programme. The Pulse is next. This is Bloomberg.